thank you so much for coming to what is by far the best session. The other ones are awful, and those people are already regretting their decisions. So I want to thank you so much. This is actually a really good day for this panel. For those whose phones aren't working in this building like mine, so WeWork acknowledged today they filed confidentially for an IPO actually back in December. And a good lesson for everyone who has these companies, it didn't leak until today because they haven't hired bankers yet, so that's where the leaks come from. And also Chewy officially filed for an IPO today, even though that's quasi. I'm going to ask each of my panelists to very quickly introduce themselves. If you go longer than 15 seconds, you've done it wrong. So, Dan.
Thank you, Dan. I'm Dan Levitan, founder of a venture capital firm that does seed and Series A consumer-only investments called Mavron.
I'm Ibrahim Ajami, and I head up ventures for Mubadala, which is a sovereign wealth fund out of Abu Dhabi.
Dan Primack, business editor, Axios.
Anton Levy, I run technology investing globally for General Atlantic, a growth stage investment firm.
Akshay Nahida, I'm a managing partner at SoftBank working on the Vision Fund investments.
I'm Kara Nortman. I'm a partner at Upfront Ventures. We're the biggest fund here in Southern California and invest in primarily Series A across consumer enterprise and deep tech.
So the idea of a unicorn, it's been like 5 years since that term was coined by Eileen Lee, a venture capitalist who runs Cowboy Ventures. And at the time, there was only, I wrote this down, she only could find 39 of them, and that wasn't just privately valued at $1 billion or more. That was companies that had even gone public at $1 billion or more going back to 2003, so in the past decade. Today, there are hundreds of them privately held, and more that go public or get acquired at $1 billion more. So, Ethan, why? Why have we seen so many more of these in the past 5 years than we had seen in the prior decade? Is it simply a public bull market?
I don't think so. I think that's a small part of the story. First of all, it seems like they need to come up with a new name just because, unicorns are not so rare sightings.
We tried
anymore.
minotaurs, but it didn't really take off. Yeah.
Maybe just like cows or something like that, or beef, or some other animal. So the reason I don't think that it's a part of the cycle or likely to change around is that there is so much innovation that we're seeing around the world. You're seeing it not just in the United States, but you're seeing it in places like China at scale, India at scale, places like Latin America. You're seeing entrepreneurship and innovation at scale. And what's happening, in addition to the people don't want to work at some of the largest companies in the world. They want to work at these more entrepreneurial companies. They want to work for themselves. They want to create the next Google or next Facebook. But in addition to that, you have 4.5 billion people that are connected with smartphones. And you're seeing companies being able to leverage that. And for less than $100 this afternoon, you can be up and running with a website and a domain name and reach 4.5 billion people. That's never happened in the history of civilization before. And when you have 4.5 billion people that you can reach for that cheap expected cost, you can have companies get big really, really fast. And there's hundreds of examples I could give you around that. But one example is Facebook. Facebook, I think, is sort of 13, give or take, years old. Did $50 billion of revenue last year and $25 billion of free cash flow. Forget what you think it's worth or not worth, or unicorn or not unicorn. Here's a company.
I guess we'll go unicorn with Facebook. We said
Facebook just limps over the unicorn status. But the reason is that you can reach these people at massive scale, and we're seeing that happen across industries, across companies, and I think that's a secular trend that you're going to be able to have this massive shift to creating companies of huge value across industries, driven by the reach that you can that's unprecedented, combined with the low cost of that reach.
Kara, do you not just agree with that, but is there another, we're seeing this kind of, this cohort of companies that all got founded around the same time, the Ubers, the Airbnbs, the WeWorks, et cetera. Is there reason to believe there is another cohort of this sort of magnitude coming around the corner that we just can't see yet? From the earlier stage, do you see that?
Yeah, I think to Anton's point, I think we believe in very similar philosophy around sort of where we are today versus where we were 20 years ago. But there are things on the horizon that may have impact of similar magnitude. 5G, for example, it's going to be 100 times faster. So when everyone in the world has a computer in their pocket, when that computer is actually connected to payment, which you're seeing in China, you're only just starting to see in the US and other places, and you can transact at 100 times the speed. Things like that seem like, make us pretty optimistic that there could be a huge new wave. And then the second piece of it is just moving into more, traditional industries. And so if you look at industries like food or real estate or healthcare or worker training, these are still largely atoms-oriented industries. And so when you think about the skill sets that will go into revolutionizing those industries, it's tech and data, it's understanding the regulatory environment. And so those are all things that contribute, I think, to a new batch.
I think innovation and the speed with which companies are now being built facilitates the kind of trends you guys are talking about. The interesting thing to me, though, is I think there's an equal revolution in the capital markets. So if you look at what's happened in the last 9 years, the amount of funding in the private markets has been greater each year. Last year was 130 billion. And so these companies, in effect, in my mind, are getting all the capital they need privately, whereas before they would go public. And, I was involved in the Starbucks IPO in 1992. They raised $40 million at a $240 million post-valuation. Today, the business is $90 billion. Facebook goes public 6 years ago at $100 billion. Today, it's worth $550. So all the juice from the returns have been sucked out of the public markets into the private markets, which has really changed the dynamics for early stage VCs thinking about funding.
I'm wondering, it's funny you say that. I'm thinking back. So years ago, there was a company here in LA called Amped Mobile, which is completely unimportant. But they raised like $200 million, and then they went under. And it was a story that, as a reporter, I covered for months, because who can imagine a company would raise $200 million for starters, let alone go bankrupt? So, Ibrahim, I wonder, for you, the kind of the plethora of these billion-dollar companies, is it because of what's being said here, that it has become cheaper to start companies, the market value or the market opportunity is so much more? How much of it is simply a herd mentality that you got to give them a billion-dollar value? I mean, Slack's about to go public, probably at a very good valuation, but Stuart Butterfield, years ago, when I asked him why did you just raise it $1 billion, he said, well, because other people are and I need to recruit.
Listen, I think you can't deny that we're living in probably the most innovation-intensive period of our life, and that's going to continue. You're seeing, completely agree with the capital revolution statement here, you're going to continue to see wealth funds, sovereign wealth funds like ourselves, large capital investors, want to come in and invest much earlier than we have previously done, because we're seeing the amount of value that's created in the private markets. Number two is you're seeing these companies grow very quick. They need the capital to invest in marketing and distribution and supply chain. We can provide that access, we can provide that capital. And last but not least is we as a large global investor, even though we want to invest early, and we're doing that by increasingly setting up in places like San Francisco and London and in China, we don't know or we don't want to do the things that Anton or Kara or Dan do really well, which is the seed investment and the A investment, which is really helping founders as they develop their products at the initial stages. That's their edge. And I think for entrepreneurs and for founders, the ability to sort of access this level of investor sophistication, in addition to an innovation-intensive period, makes it very attractive for founders nowadays. So, I mean, net, I think you're going to continue to see this trend. Massive capital coming into these technology companies and then staying longer, much more than previously have. And when they're ready to go public, you're seeing it now. They're now starting to go public.
So now starting to go public, and actually you're part of Vision Fund, but you're kind of focused primarily more on the public side. You come from the public side originally, not from the public side, but investing in public companies. Why is it that so many of the, we've talked so long about staying private longer, but 2019, really the last 2 months, seems to be the moment where everyone said, okay, time to go. Why now?
I think if you think about the batch of companies that are going public right now, and you think about when they started, it's almost been 10 years. And most of these venture capital funds, that's their fund life. Yeah. And so some of that has got to do with the fact that the valuations have gone up so much. The only way to absorb that level of capitalization is really the public markets. We did do a very large secondary in a couple of these companies that are going public. So employees and early investors did have an opportunity to exit. But I think, at the end of the day, public markets still continue to be the way where you can actually end up selling down your stake over time, especially of that kind of size. So.
But the early stage VCs in these companies, and I asked the people on my ends who are the earlier stage VCs, once you've gotten to a position where you've got a portfolio company that's raised $500 million, $1 billion, SoftBank's last, you don't really have any say anymore, do you? Over what the company, you might say our fund's coming to the end and we could really use liquidity. These companies can simply at that point say you don't matter to us anymore, can't they? Don't they? I don't mean you don't matter, but you don't matter. Am I wrong about that?
I'll defer to Kara first.
Oh, Dan, I was going to defer to you first. I'm happy to go first. I think we're all fundamentally minority investors. And so, sure, when you take in later stage capital and there's structure and there's rights and there's, conversation around it, but we're all playing repeated game theory where we all need to invest together and work together to make the best decisions for companies. And all of these companies are fundamentally almost always running out of cash. So every 18 to 24 months, everybody gets to look around the table and re-up. And I think as the early stage investor, we have influence in so much that we can influence the founders because we've usually been there since the beginning. And then we hopefully can be helpful just as a productive member of the board. And you have to look at the board like a team. So, when things are going well, it's all easy. And when things are going poorly, then those that will step up and do the work and put more money down often, unless you're looking to put a company out of business, will have more authority and ability, which is why I think you're also seeing a lot of earlier stage Series A funds raise growth funds.
Or you're benchmarking, you sue Uber.
Yeah.
I'll take that.
Let me ask as a follow-on to that, though, because you mentioned Starbucks and Facebook earlier. One big difference between most of these unicorn IPOs we're seeing now and Starbucks and Facebook, those were profitable companies. Most of the companies, with the exception of Zoom, which is now worth more than Lyft, almost all of them are unprofitable, in some cases spectacularly unprofitable. If they stayed private longer because there was more access to the capital market, shouldn't they have also, since they were private longer, figured out a way to make money?
I think you should talk to these big late-stage guys.
Okay,
Right.
Some will, some. I think. I just want to comment on this IPO point because I think you keep coming back. In addition to some of these companies ready to go public and the public markets are ready for them, obviously public investors want access, especially to ride-sharing companies that they've been locked out of. But there's probably another dynamic happening, which is these companies are now starting to hit a point where they also need that public currency to continue to attract and retain employees. We have been in Silicon Valley for about 2 years now, and we've invested directly into about 16 companies. It is shocking how much talent attrition happens in these companies in Silicon Valley, and how many of them they get so excited about joining some of these startups, and then a couple of months later are hired away by like a Facebook or a Google because these companies are giving them such large packages. So the ability for these companies to continue to retain and attract some of this talent, I think as a public company, I believe, at least we're seeing, is becoming more important.
You think so? It's more important today than, say, it was 2 years ago?
Because of what you're seeing with large companies like Google and Facebook, where the concentration power is so much that they're just giving anything they can to attract this talent away. And it's absolutely vital as these companies continue to grow globally and execute to get the best talent out there. And as a public company, it's an important currency.
Do the profits matter?
Absolutely.
When?
You got to keep growing global. We're seeing immense founders. We're seeing great companies in Europe, in Asia. You're seeing the role that SoftBank Vision Fund, and they'd actually comment on that, SoftBank Vision Fund. In the beginning,
which was only like a year and a half ago. In the beginning.
3 years ago. All these VCs were not happy about the SoftBank Vision Fund in the beginning. Everybody's like, well, SoftBank Vision Fund, it's too big. Who needs this capital? We don't like them. They're gonna. And all of a sudden, 2 years later, all the VCs love the SoftBank Vision Fund.
You really think they all love the SoftBank? I mean, they'll say that to you, but do you think, privately, together in their little groups?
A lot of these VCs have made a significant return because of the SoftBank Vision Fund. And SoftBank Vision has played a big role in supporting some of these companies as they go global, as they continue to invest in their technology, and become market leaders in their respective markets and segments. So I'm taking a view that these VCs love the SoftBank Vision Fund.
I should also say your firm is an investor in the SoftBank Vision Fund. Well, actually, let me ask you
Yeah,
that. 'Cause
sure.
there's a perception out there, and tell me the perception's wrong. There's a perception, and every portfolio company is different, and strategy is different, but that generically speaking, that part of Vision Fund's message to founders and to CEOs is, don't worry about the bottom line, we've got you.
I think that's not true. We think about the bottom line. We just think about when we want to turn the lever on in terms of profitability. So if you are the market leader and you can consolidate your position and you can keep growing and scaling, then that basically gets you to a place where competitors, new startups, etc., will find it very hard to come in and compete with you. And once that happens, you can turn the profit lever on. This is a
But
playbook.
when you turn the profit lever on, though, doesn't that then turn the growth lever off?
Not necessarily. Look at a company like Alibaba, which is our most famous investment as SoftBank. It didn't make money for, I believe, 14 years, and then they turned the lever on, and they've turned 2 on. They have another 6 yet to go. And, you know.
You want to identify those 6?
Sorry? No.
Anton, let me ask you about it. I mean, I guess when you're investing at your stage, but I mean, how do you as an investor view the path to profitability? And more importantly, how do you think where the public markets are at caring about this right now? For these companies going public, it's one thing for a company to not be profitable on the day it prices. It's another thing for some of these, and I know you're an Uber, but so let's say Lyft, which has basically said to investors or prospective investors, we have absolutely no pathway to visibility. We're hoping to get there someday, but we may never, ever, ever.
I think, first of all, a couple things. I think, one, the disclosure in the prospectus are legal disclosures. So,
well, it's legal, but I mean, for Lyft, they have some tax credit that's like in 5 years, but the tax credit is specific to earnings, and they basically say, we don't expect to get it.
I think some of that still, I would imagine, is some legal disclosure that their lawyers are having them be careful. They may or may not mean it, but I think a lot, and I don't want to know specifically about that comment, but in the Lyft case. But look, I think it's a lot about what's the ROI of the investment. And so, if you're one of these companies that if you can spend $1 today and you believe you can generate $3 in a relatively short amount of time, most of us sitting around the table, yourself included, would say, hey, that's a good investment to make. I think that's the conversation that most boardrooms are having, most investors are having. They're pretty rational. Most people are not just saying, hey, spend $1 and we think we're going to get 85 cents back in 5 years from now. That's not a way to stay in business. And I think it's very rare that people are making those decisions. And so I think people are pushing the accelerator and saying, hey, if I can spend $1 today and make $3 over the next few years, then the question is how much? And I think, there are certain investors that are saying spend $1 billion or multiple $1 billion in that case because you're going to make a return on that. And others may say run at break even, so you don't have to take future dilution, and there's a debate that happens around that. But I think the public markets understand that, and people are talking to public markets, and they're saying increasingly breaking out profits. So even see a lot of companies, I think it's very smart, companies like Alphabet and others that are setting up structures and saying, look, here's my core business. Waymo may be very negative, and I'm making investments there, and so on and so forth. And here's our biotech investments. And you're seeing increasingly companies that are breaking out for the public markets and saying, look, we are behaving rationally. Here's a business, if you want to not value that or shut that business down.
Does the Zoom video, so Zoom, for those who don't know, it's a video conferencing company. They didn't disrupt anything except Microsoft and Google and Cisco. But they, I mean, their claim to fame is that they were slightly profitable. And the public markets went absolutely crazy for them. Even more, look, Pinterest has done well, but not nearly as well. Lyft has gotten its ass kicked. Is there some argument to be made that the public markets really are thirsty for a profitable company if it can show up, and that you could do even better if you show those profits?
I think the thing that's impressive about some of those companies that are growing really, really fast and are profitable is what they're seeing is that they're investing a lot for growth, and their business model is so attractive that they're almost profitable and almost in spite of themselves. And what I think that demonstrates to investors is that this business model is incredible. And so I think people are giving companies like Zoom a significant premium because they're saying, look, you guys are still growing at 100% plus growth rates and being profitable. And that just shows the power of a business model. My guess is if the Zoom and it's not a company we're investor in, but my guess is if the Zoom management team could invest $1 and grow at 200%, they're growing so fast they can't find enough ways. But I think people are more rational than the market gives them credit for. And maybe the last thing is, you look at Pinterest or Zoom, you made those comments. In terms of market cap, today, there's actually not a terribly large difference in market cap between those two companies. Just one went public at a price and the stock went up.
One also raised about 10 times the amount of venture capital.
There's that too, but they're actually similar market cap companies is my only point. One is you just happen to see a huge rise the first day of trading, and since then the other maybe more of a modest rise. But again, both are, I think my point is both are high teens billions of dollars of companies.
Dan,
oh yeah.
Can I jump in on this IPO thing? I think it's really interesting. We're 5 years into this experiment of large firms like SoftBank and others basically taking outsized platforms of influence and putting in hundreds of millions, if not billions of dollars. If you think back 5 years ago, entrepreneurs were all saying they don't want to go public, they don't want to go public, they don't want to go public. And part of that was why not? They had largely a collaborative cap table, and they could keep growing, as Anton's saying. I think what will be interesting, and what I've kind of talked to some founders about, is do you want to be captive to one investor? And I think an IPO as a way to get to good governance actually, in my mind, was going to happen more and more over the next 5 years. First, I think...
Does it count if there's a dual-class stock structure? Is it still good governance when you go public?
I think it's better governance than being private. And I think that the companies that I've taken public, many times the founders saying, I'm surprised at how smart some of these public investors are. And I think if you look at Uber as the classic example, that was a highly dysfunctional governing structure in a private setting. And the IPO, bizarrely, is an attractive thing for the management team because they're being pulled and torn in different ways.
That's interesting.
Can I make a comment on this
Yeah, sure.
platform of influence? Because I think...
you don't have to ask my permission. You can just talk.
I was told that I have to.
No, you don't. You
Okay,
don't. Definitely don't.
So the global investors with significant amount of capital from all over the world are trying to understand and grapple with this large technology platforms that have significant influence on society, whether that's on transportation or healthcare, commerce, or real estate. And it's precisely the reason why you're seeing investors like us that are based out of Abu Dhabi, like Moderator, that are saying, listen, we have to start really thinking long-term and being much more active with some of these technology companies early on, because they could grow and become real influential in how they impact society. Just to give you an example, we had invested in this genetics testing company in California, and we brought them to Abu Dhabi, and we had...
Which one?
It's called Color Genomics. And we brought them to Abu Dhabi, we enrolled them out to all our employees, so Color Genomics, based in San Francisco, now has more data about the employees at Mubadala than the healthcare system in Abu Dhabi, just because of the access to the genetic data. So we're saying we've just invested in a startup that now has access to all this healthcare information. And my point here then is data is becoming such an important source of differentiation in building these platforms, and capital is going to follow. And that's going to continue to impact how my fellow venture investors here think about investing, how the public markets are going to be impacted, how long companies stay private. That trend will continue. It's a massive secular shift.
So, and Kara talked about 5G as possibly being, we think back, 8 years when Airbnb and Uber, et cetera, were launching, and it was really, there had been mobile phones, but it was really the smartphone that was the paradigm shift.
Most important decision.
Is there a feeling, is there agreement here, because this seems to be a question, which is that you've been able to plug, or firms have been able to plug large checks at very high valuations, particularly into consumer-facing, sometimes enterprise, but software businesses, true kind of traditional software businesses, whether it be enterprise or consumer-facing, and a larger question of, can you plug that kind of money into biotech companies, consumer product companies that are pretending to be software companies but aren't, food companies, et cetera, Or does that not translate? Is the unicorn phenomenon, is that almost exclusively reserved for software, and everyone else who's pretending to come on top is in deep, deep trouble?
I'll let SoftBank take it in a second. I'd start by saying, I mean, if you look at GDP spend, right? If you look at the amount of money going into food, it's over $1 trillion. You look at the amount of money going into healthcare and the inefficiencies and inflationary pricing. My hope is the answer is yes. I think the bigger question, particularly at the early stage, is when should the capital come in? Because you could take consumer as an example. If you flood too much capital into a company that's fundamentally a consumer products company that's building a new form of distribution or just-in-time delivery or whatever it might be, you can easily model it out to show paybacks and CACs and the kind of the fundamentals of the business working. And then but actually, once you throw a bunch more money in, the fundamentals break down. And so I think there's a question as to when the capital comes in versus some of my enterprise software companies where if you have a bottoms-up SaaS model that's pretty viral, low cost of sales, really high margin, and it's working, I think you feel a lot more comfortable a lot earlier putting that capital in. And I'm sure everyone has a different opinion, but that's how I think about it.
Yeah, and actually, as a piece of this, I guess part of it being this idea that in a lot of cases, capital is, in the private side, is at least being viewed as a potential kingmaker, right? Like, you got two companies doing something similar, particularly in the consumer space. You give one of them $300 million. That's going to get market share, which is the key. Does that work in other sectors? Does that work in things like AI? Does that work in things like biotech?
Well, I mean, AI and biotech is all about IP. So if you have great intellectual property that no one else has, then by definition, if that adds productivity, efficiency, whatever to the product that you're selling, then more capital behind that is going to help the company grow faster and become very dominant. You'd like to think that healthcare can take a lot of capital, given that it's, 17-18% of US GDP goes towards healthcare. So we made a few investments in the healthcare space, Guardant being one of them. It's a IPO that just happened a few months ago, 6-7 months ago. And again, we invested in Guardant about 2.5 years ago. We own about 30% of the company, and they were focused on the US. We basically, with our capital, amplified the ambitions. We took them to China, Middle East, Japan, helped them grow through our ecosystem. So when we invest in these companies, because of the ecosystem that we have globally and our ability to be able to help companies like Guardant expand into geographies where they weren't even thinking about going to, I think that there's a little bit of a I think when people read the numbers in the press and people don't understand what the business model of these companies is going to become once.
Well, to solve that, next time you guys do a deal, you can send me the investment thesis and the papers you submit internally to vote on.
I'll connect you with our PR guys to help you do that.
I think one comment is that I think there gets a lot of press, a lot of these, the term unicorn, the value creation, it gets a lot of headlines and they're staggering amounts of value creation, and that's good press. But I think what also gets lost in there, which is a little bit of what I think some of your question behind your question, Dan, is that there's so much innovation going on around the world. I mean, we meet a new $100 million revenue company probably a week that we haven't heard about. And we have 50 people all over the world that are searching for these things, just in software and in tech areas. And so I think what's also lost on there is just the incredible amount of innovation that's going on. And you're seeing it across industries and other areas. I mean, my guess is...
So is this time it's different argument?
No, well, I think that it's just the innovation. We're in an unprecedented time of innovation. And I think fundamental rules of finance are the same. So you ask about things like profit and cash flow. Companies are always going to be valued net present value future cash flows. That's never going to change. Now, in the short term, there may be volatility in different people's interpretation of that. But what's undisputable is the amount of revenue, growth, earnings, and productivity that you're seeing, and how long that continues in terms of, are you going to run out of good ideas, or are there new platforms coming? But I can just tell you that there are hundreds and hundreds of companies that none of the people in this room have ever heard of that are going to be doing hundreds and $500 million and ultimately billions of dollars of revenue because of the innovation that's being created.
I think every consumer category that we focus on, how people live, how they move, how they entertain themselves. Every category is getting reinvented. And it started with technology, but I think that it's almost business model innovation and super fast iterative thinking. And I think, getting back to your question, to me, where consumer companies have gotten in trouble is there are certain friction points for scale. And where you don't understand those friction points and you silly spend money in CAC, that's where big problems come. But in businesses like Uber, I mean, the relevance of that on a worldwide basis is so profound that I think you're seeing for the first time in our lifetime the hyperspeed to scale nationally and internationally.
Okay, so let me ask, I want to follow up and kind of, on the kingmaker idea, when you get into it, and Kara, this could be for you too, when you invest in a company early, whether it be an A or a B and you're still there, how much fear do you have right now that the quality of the company, the quality of the founder, the quality of the execution, hell, maybe even the quality of the product, can ultimately be less important than the fact that whether it be SoftBank or Fidelity or somebody else decides to give $300 million to its rival? And they basically can buy the market share. I mean, from the everybody's pleased with SoftBank to the folks who, and I wonder as a VC, are you in a situation where you really are in a really tough situation, which is either you take more money perhaps than you even want, but the alternative is the rival takes it and crushes you.
It depends on the category. We had a company in to our meeting this morning that I telephoned in on, and we believe that this is a winner-take-most market. So after we do the A, that is a very relevant question of either take it or potentially have them fund one of our competitors. That's a real decision that happens frequently these days. I would say that my own take is we're 8-9 years into this cycle, and my sense is that when we're in cycles, we don't fully understand how extreme they may be. And I remember that in 2000, and I remember that in 2008.
You were shaking your head when I asked the questions.
And we're going to rely on, but that's not what SoftBank does. I mean,
Rover,
I feel like I'm defending SoftBank.
you are. This is good for you. It's like you got a shield.
my
to my
penny.
right.
First of all, we rely on these investors, you know, especially at the seed, the product, the market, the founder. I mean, ultimately.
But if you ask Postmates, if you ask Rover, they would certainly feel that way.
Yeah, DoorDash doesn't.
No, because they got the money.
DoorDash,
they
yeah.
took the money.
Yeah, and their
But by the way,
execution
DoorDash,
excellence.
we just did the round
Yeah.
a year ago. After that, the 2 follow-on rounds were done by other VC
Absolutely.
firms. So it's, you know, again,
Dan,
But if you're a rival for DoorDash, you feel that you're not. And look, you can make an argument that DoorDash is a better company, but if you're Postmates or someone like that, you look at it to a certain extent and say, we're not losing because our service isn't as good or our product's not as good. We're losing because someone else gave them a ton of money and is willing to subsidize bigger losses.
that's absolutely not true.
Yeah, I don't
Because when
That's
you
how
look
they
at
feel.
it,
I can tell you that is how they
Look
feel.
at
Is that how
the
Grubhub feels?
execution.
Grubhub
Look,
stock's up 4x.
Grubhub is not thrilled with what's been happening with DoorDash.
Stock's up 4x, but it's not a winner take all. I'm just saying the kingmaker idea, I don't think applies. to this.
Grubhub's stock has kind of flattened a little bit lately, and Grubhub, and you talk to DoorDash basically says they're eating into Grubhub.
Over 35% of SoftBank companies have received follow-on rounds higher than the valuation that SoftBank paid
But that
for
doesn't speak to the question.
from other investors, from
Yeah.
other global private investors.
Right.
There is money out there beyond and above SoftBank.
No, I'm not just saying it's SoftBank, but I'm saying for large checks. This idea that it didn't use.
But Dan,
that's new. That's a new thing.
But you got to look at the data, right? Look at Uber. Like Lyft's taken market share. I mean, we're shareholder of Uber.
exactly.
Lyft's taken market share since their investment.
In ride hail, but Uber's expanded into other things. I mean, that's
But
what
in the
they use the money
U.S.,
for.
the kingmaker idea is Lyft
But wait,
out of business?
But Lyft raised a fortune from these big investors. I mean, that was a different sort of situation.
But you asked a question, which is a SoftBank and
Or any other large
or any others,
investor.
coming in and putting $500 to $1 billion. The answer is it's just not supported by data, right? Look at what's happened to Lyft since then. Have they gone out of business? Have they lost market share?
They're not. They're having a bad run of it right now, Anton. You've noticed this, right?
You're talking about the $20 billion market cap?
It's not anymore.
Dude, it's. I mean,
They're not above the last round price anymore. I heard that somewhere. They're not. They were. They're not. I haven't seen today. They weren't on Friday.
I think if you go back to the
I'm sure
DoorDash
they're pretty happy
example,
with their market cap at the moment.
Okay, so everybody is thrilled with this thing that VCs keep bitching to me about on the phone. Okay, that's fair. So, actually, I'm curious. Is Vision, is it a venture capital fund or is it a private equity fund? And I don't mean technically with the registration, but I mean what you are.
We're a growth stage venture capital fund. I mean, you can call it venture capital, private equity, whatever it is, but we're a growth stage investor. So we want to come in after a company has scaled significantly. They have a clear market leadership position. And we believe that we will be the last round that this company will need before they have to go public or whatever. So we are not early stage. We leave that to the guys like Sequoia and Excel and others who do it really well, Benchmark, etc. And we're very happy to wait for companies to actually prove out their business models in one geography or one sector, and then we can expand that and take them global and have founders think more about the long term and building enduring moats than think about, I'm going to run out of capital next year and I need to go for another capital raise.
Kara, I wonder, it might have been you, or maybe not, talked about kind of the idea of almost private IPOs, not true liquidity, not for everybody, but the idea that a company that might have gone public after year 5 is now going public after year 10, but what they're doing instead is they're taking a big check at year 5. As an early stage venture capitalist, VCs traditionally, once a company went public, maybe it was after the lockup, but would eventually leave the board and would step away, would sell their stake or maybe hold it. Do you feel now at the early stage, are you kind of involved either until a company either goes public, gets acquired, or until one of these big rounds? In other words, do you view your job almost as being over if that $500 million check comes in, but it's still private?
Yeah, no, I mean, I think we're viewing the length of our job extending for all the reasons we described earlier. We're typically on their full journey until they go public, sometimes even after. And so I think what you're seeing is more opportunity for people who have asymmetric information at the earlier stages of venture to make sure we can participate and support from an economic standpoint to support the length of that journey. So I think every fund probably looks at it differently. The core thing that distinguishes, I think all of us are maybe similar in this way, us from a seed fund is that we take a board seat, we often lead or co-lead, and we sign up to support it kind of throughout.
And I think to that point, what we're seeing too are the exceptional founders are starting to are much more thoughtful about curating their investors, not only on their capital, but on their board. Right? I can't do what Kara does or what Anton does with some of these founders, but they also can't do what Mubadala does. Right? So at an early stage, some of these founders might say, what, I might not need Mubadala today at the Series A, I might need you at the Series B.
So what is that? So for you, what's the generic value add for you guys? What's your argument when you're in the room?
So two major arguments. Number one is Mubadala partly owns or majority owns over 65 companies globally. These are large companies in energy and real estate, financial services, banks, healthcare, hospitals. We can help our founders access these companies if we believe that these founders are building exceptional products. And number two, once we do find a winner, and the goal is once you do find a winner, that you can back this company. You can keep backing this company because that's a winning company and helping globally. Whether that goes back to Mubadala or we give them access to SoftBank. But that's the kind of level of curation, not only at the local level, but at the global level that you're starting to see some of these founders be much more thoughtful about. And it just impacts the board dynamics about value creation and supporting these founders. Whereas before, you didn't have that.
Well,
Hey, Dan, and I want to jump in with a quick example on our side. So we were seed investors in Ring. Great big outcome for us here in Los Angeles. I think we were the only fund that was in every round. We played, lead roles in the beginning, and then we took a step back. Those early rounds weren't easy, and then they got a lot easier. The final round, they had a big late-stage investor who was going to lead the round, who remained nameless, and they had a frivolous lawsuit.
They don't have to remain nameless.
They had a frivolous lawsuit out there pending against them. It was supposed to be dismissed in a summary judgment. It wasn't. Lead investor got spooked, pulled out, and in a very short period of time, a week or two, we stepped up and we led what became an $80 million round with a $20 million lead check at, I forget what the letter was, E or F. which ended up becoming a great financial return and success story. But if you talk to Jamie Siminoff now, he'll say, they were my early stage fund, but we had seen him execute all the way through. And so when the market had a frightened moment, we could step up and catalyze that round. And I think that is the value of a long-term early stage investor. Our job is to help you build the team, help you get capital, and be your sparring partner. And I don't think that really goes away until you truly are at a point where...
Can I just comment on that and I'll
Yeah.
stop? I promise.
No,
Which is
it's
like
I also,
the point that Kara just made around being involved in a company over a period of time, 4, 5, 6 years, is so important for a global private investor like ourselves, because you're learning with them, you're growing, you're seeing them pivot, you're seeing them evolve their product, their market, their strategy, how they navigate recruiting, changing management team members. And then when it's time for a much larger investment, you are just much more confident and comfortable, and you're able to determine whether this is the right time to invest.
Yeah.
I was going to say, look, I know that people are focused a lot in the last couple of years, but this has been going on, this phenomenon, for a long time. I mean, Facebook took, hundreds of millions of dollars in investment from Yuri Milner in 2000.
And that was pretty
2000
controversial at the time, though. That was
2009.
kind of the one that broke the dam, right?
I think that, but it was even happening before that. I mean, I think it's been happening through cycles, and for a long time, it's got more of it. It's what's
I
accelerated.
think about Facebook, I don't remember if they were before or after Yuri, but when Greylock invested, I think at a $500 million valuation, it basically broke the firm in half. I mean, because it was so controversial inside the firm, and it was kind of, well, the East Coast guy said it's a terrible idea, West Coast guy said it was a smart idea. You might notice Greylock doesn't have anyone on the East Coast anymore.
Yeah, I can't speak to that specific question, but look, it's been going on for a long time. A lot of these big rounds, Flipkart did, billions of dollars of capital. So I think this phenomenon of access to private markets, reasons for companies to stay private longer, again, I think that's a cycle. It's happened through cycles. I think you're going to see it through the next, whatever pullback comes when there's a recession.
Do you think we should view what we're seeing right now in so many of these brand name companies that have remained private for a long time, could still probably access the private markets if they need to, either equity or debt or whatever, going public now, should they be viewing that as a market peak?
I don't think so.
Does
I think it may or may not, if it would be maybe a coincidence that that's the case, but there's lots of great companies that are still private.
Then is it just a domino effect? 'Cause it is odd that so many of them are doing it right now, that these are companies that somebody, Dan, you said, a lot of these companies started 10 years ago. They've still got access to capital. They've been kind of wishy-washy when you've asked them, are you going to go public? Oh, well, we're planning, but no rush. And then suddenly just all of them together, all basically within 3 quarters.
I think you're reacting to the dearth of them in the last few years,
Yeah.
as opposed to the plethora of them now. If you look at the number that are going public versus the number that are still private, it's a minority. But I'd like to go back to the board thing. I think the key to being a good investor is figuring out what you like and what you do well. And I got into early stage venture because I love to create the psychological contract with the entrepreneur at the start. And it's great to hear a late stage investor really understand that pattern recognition happens at the early stage. And, I'm on a board now. I've been on it for 11 years. Company went public 4 years ago. The CEO has said he'd like me to stay on the board. So I think each case is different, and I think it's highly dependent upon the founder or the management of the company and kind of how they curate their cap table and their boardroom.
We are going to go to the audience for questions in just a couple minutes. A few follow-on questions related to this. Ibrahim, I have to ask you because you were up here, and you've talked about, kind of how you guys established an office in Silicon Valley a couple years ago. You're in Silicon Valley. I'm curious, and you probably thought this was for you, but it's coming to you. Which is, how do you square, and particularly when you're talking to entrepreneurs, you talked about what you can bring to entrepreneurs. How do you square the politics of UAE with the politics of Silicon Valley, and does that come up when you're talking to entrepreneurs? It is a country where homosexuality is illegal, et cetera.
Listen, Dan, we're building a team. We've built a team in San Francisco. Many of them are from the Bay Area and from the United States. We have some people from Australia.
But the money's coming from there.
We have people from Europe. We're a commercially minded entity. We're focused on supporting the founders. We're focused on identifying the right venture managers and helping them through the journey. 99% of the time, the discussion is around how we helping this company build a global, successful, sustaining enterprise. That's the role of Mubadala, and that's the role of the team in Silicon Valley, which is how do we support these tech companies?
Actually, I have to obviously ask you, had SoftBank Vision lost the deal it wanted since Jamal Khashoggi was murdered?
Not that I'm aware of.
Not that you're aware of. I know it's come up during discussions. When an entrepreneur says, I'm uncomfortable, prospectively uncomfortable for my employees' sake, taking money basically from a government, what's the response? What's yours? Yours, I mean generically, Vision's response.
Again, I haven't been put in any of those situations, but my general experience and understanding around companies that come to us is they're really coming to us because of Masa's track record and his ability to identify companies, change business models, etc. And I think that that's one of the main reasons why founders are attracted to us, because of our long-term horizon and our ability to be able to help them scale and go global.
But that said, so no conflict. I guess this is for either one of you. I do have to ask you have in Silicon Valley so much talk. Google starts a project for the U.S. Defense Department, and you got engineers who are fighting against it. There's so much, whether you want to call it social consciousness or activism on either side inside these companies. You don't feel it when you're going to them, because they're feeling it from their employees on domestic issues. You don't feel it.
We're engaged with companies in Europe. We're engaged with companies in the Middle East. We're engaged with founders in Asia. We're operating like every strong, commercially minded, technologically astute investor out there, and that's what we're focused on.
Let me, one final question, and I just want to go back, and now I'm going to switch from something very serious to IPOs again, which is just very quickly, how important, Kara, I wonder for you, how important is the overall aftermarket performance of this group of IPOs to the future of the VC industry? And so, one company does really well, one company does really badly, so be it. They're all individual. But we're going to see enough of them, these kind of companies that were valued at, to be honest, $5 billion or more at the private markets, come public this year. I mean, Uber and WeWork and probably Airbnb and Peloton and already Lyft and Pinterest and Zoom. How important is it to the future of the VC market that these companies, on average at least, outperform their last venture rounds?
I don't think outperforming the last venture round is as important as building permanent, sustainable public companies that are transparent, have diverse investor bases, and ultimately they should outperform, right? Because we should be building much bigger companies. But I don't follow the public markets as much of a sport as some in the later stage. I mean, and it does have impact. I think it has impact in really positive ways. For founders to recognize that, I mean, all the best companies always have a chance to sell. And we're often, we're often sitting there trying to convince those founders to go for it, because it's so rare to find a team and founders in a product that can become a real big business that can go public, that you want to see that there are multiple paths, that you're not just role modeling against this one company that went public in the last 5 years. I think that's really positive. But ultimately, the short-termism, I mean, if you read up on all the sort of technical analysis of some of these companies, one thing I know is it's wrong, right? And I just don't know exactly where it's wrong. But over time, you look at Facebook as a great example. It was in the doldrums for a long time, and even now, as it's going through a moment that has its ups and downs, it's, as you said, worth $500 million.
Well, weirdly, it's had its ups and downs in terms of the headlines and even some of its own employees. The stock hasn't really, with one exception, when the Cambridge Analytica stuff came out. In general, and this has been true of a lot of these companies, the headlines can be terrible and sometimes legitimately terrible, and it hasn't affected the stock. The stock's still just flying higher.
So, I mean, I think it's important to have a healthy set of outcomes for founders, for venture capitalists, for our LPs, to show we can return capital in a variety of different ways. It just makes the whole market healthier. But these companies, I think, need to perform over years and not over quarters.
Actually, just to you, particularly somebody who came from the public markets, how is when we come to the end of 2019, assume there's not some other macroeconomic event that kind of skews everything, how important, kind of for the future, to be honest, for the future of your investments and kind of the next company you value is what happens this year?
I think Uber probably is going to create a benchmark for a lot of the new gig economy businesses, just because it's so dominant, it's large. So generally speaking, I think public market investors are going to track Uber's valuation pretty closely to determine where they should be benchmarking other companies that are coming through. And in a similar vein, I think Pinterest, probably, I saw some comparisons to the likes of Twitter and so on, and I just think that's how public markets have worked in the past and will continue working in the future.
And to that point, Anton, is there a company you're just particularly interested in that could be going this year that you're not in? I didn't ask you before, so I'm just kidding.
A company that's likely to go public this year?
Yeah, one that you're watching that you think is going to have an impact on your future, whether it be a strategy per se, at least the prices you're paying for things, offering to pay for things.
I don't think there's one company itself that matters in itself so much to a benchmark generally. I mean, there's so many that.
Would you, I wonder, would you, and almost buy as an ETF, would you buy basically an ETF of this year's VC-backed kind of unicorn IPOs at the IPO price, personally, out of your own cash?
What's your time horizon?
I don't know, what's your time horizon? It's your money.
Look, it's a tough question. I probably wouldn't because I have access to what I do at General Atlantic, and I think we can navigate risk-reward in a better place. I think if you said, hey, I could buy an ETF of being long technology for the next 20 years and innovation, I would back up the bus.
We can do Q&A. If there are Qs, there are people here with A's. Just raise your hand if you have one. I think, yeah, back there.
Yeah, my name is Nick Smoot with Innovation Collective, and we focus on small markets around the world where people are feeling less and less connected, and the theme of the conference is driving prosperity. Great conversation about IPOs in the big cities. How are you thinking about the fact that humans are becoming less and less of a part of these big rocket ships, later stage IPOs, and yet they still have good ideas, and how should they be accessing your capital?
Anybody
Want
want
to try that?
to? You?
I think, you know, to especially this is maybe for my U.S. fellow venture capitalists, the innovation that's happening around the world. Uber just bought Careem in the Middle East, which is the ride-sharing company. I mean, this is a story of two guys who got together in a small apartment and launched their product in 5 weeks. The talent that's in Europe, in the Middle East, in Asia, and even in some parts in Africa, the ability to build these companies very quick. I mean, we complain here in the U.S. and VCs say there's too much capital, there's so much capital. There's so much talent out there in the world that would love the opportunity to access the capital that Silicon Valley founders have. And you will start seeing a lot more capital go to these different parts of the world because they are building special, innovative, high-growth companies.
Is the fear, though, that it's going to those two guys and the other senior executives at Careem for companies that, at least in Uber's case, ultimately wants to not have too many humans actually working there, which I think maybe was part of the point you were trying to make. I could be wrong.
Careem has offered better employment, better living opportunities for people around the Middle East and North Africa than any other technology company in the world. So whoever says, I mean, Careem is a great example of how much it's improved the standard of living for people that didn't have access to even jobs around the world in the Middle East and North Africa. So I think it's a point that it's a misconception around what technology is doing. It's opening many new opportunities for people.
The way I would answer that question is, and we're US only, I visited with a company in Boise on Saturday night. In the last year, we did 6 investments. 2 were in Silicon Valley. 1 was in Austin. 1 was in Toronto. 1 was in Boston. 1 was in New York. I think there are consumers all over. And there's 2 levels of innovation that's happening. One is people are going to places like Boise for lifestyle and more inexpensive ways to start a company and recruiting a certain type of employee. And the second thing is through technology and through the delivery infrastructure that's grown up over the last few years, you can serve customers in rural areas. So we backed a company called Kids on 45th Street, which is targeted toward moms who can't spend money to clothe their kids. And they target 3 to 8-year-olds, and they send you a bundle of clothes for your kid that you've specified. And each one of those SKUs is used, and it hasn't ever been tagged individually. But it's a service that has a super high repeat rate because people need to clothe their kids through a different season, and they can't afford new stuff.
And Dan, I'm going to jump in. My side hustle is the women's movement, and a big part of what I think all of our moral imperative is to create wealth, create education, create community for people who don't look like us, who aren't represented by the firms we sit in or the companies we invest in today, and to continue to do better. And it starts by just getting different kinds of people into the seats, investing in different geographies, building wealth for different kinds of entrepreneurs so they can put it back into the ecosystem. One quick example, my most recent investment was in a company called The Wing. I'm heading there after this, and that's a company that's basically built a co-working and social club for women all over the country, and soon it'll be digital as well, to do things like provide community financial literacy, help in employment. And so capital doesn't just come from big funds. I mean, it can come in small ways. It can come in inspiration. It can come from taking a meeting with somebody who you might not invest in, but you can help get investment some other way. So I think it's important to encourage innovation across all the different places in the world in which it can happen, and not necessarily at the levels that require hundreds of millions of dollars.
This isn't directly your question, but I'm curious. Actually, there's been an argument that's been made that the kind of staying private longer, while that's been good for a lot of the founders and obviously for you guys, because otherwise you wouldn't be doing this, it has therefore more concentrated the wealth creation out of these things. If you're something like Amazon, which went public, and I'm going to make this up now, but whatever, it was worth like $100 million, whatever, when it went public, and that wealth creation was much more dispersed, lots more mutual funds, a lot more people, as opposed to today, where it is a much smaller group of people. It might be you guys and your LPs, and some of those are foundations, but in general, there's less broad wealth creation out of the unicorn class.
I mean, if you look at a firm like General Atlantic, I mean, your LPs are pension funds and endowments, and so I mean, the wealth creation is broad, and it gets dispersed across pensioners and so on and so forth through these vehicles. But I mean, from a regulatory perspective, it's not possible for us to open up our fund to retail investors. It won't work.
Right, no, that I understand, but I mean, so just broadly speaking, has the unicorn phenomenon, is there a kind of a social, and I just think of the kind of the Milken ethos here, at least the conference ethos, is there a bit of a social problem with the stay private longer just because you are concentrating the wealth a little bit more, just by the way the structure works? I'm not saying it's the fault, and I understand the regulatory restrictions.
I mean, if you think about the job creation these companies are doing, and you think about how many millionaires were created from one company like Uber, I think it's widespread. I think there's massive job creation that's happening. So there are many different ways of thinking about how wealth creation is happening beyond just capital gains, right? I mean,
We have 1.5 minutes. Do we have one more really quick question? Yeah, just scream it, and it's going to be really fast. Direct it to one person.
So Slack's the second company to choose a direct listing. Looks like they've added more advisors to their role of advising company on this. Do you see this being more of a trend to address the opportunity for affinity investors and the opportunities to invest versus a traditional IPO?
One person can take it, and that will be the final word. Anybody want Slack?
I think Spotify started the trend, and companies like Slack, Spotify, that have free cash flow visibility, that have enough cash on the balance sheet. I think this is a trend that we'll continue to see because there's no need for them to go out and raise capital. And they have a pretty diversified shareholder base already because they've been private for so long. They've had multiple rounds and employees as investors.
I want to thank everybody up here. Thank you, and thank you for coming. Appreciate it.